So yes, you might be in a low tax bracket, but is it temporary? So if you're in the 12% tax bracket and you're going to be in the 12% tax bracket for the rest of your life, why would you do a Roth conversion now?
Right.
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 I mean, I can give you a couple of reasons why, but if the sole purpose is to pay the least amount of tax in your lifetime, you're just prepaying tax for down the road. Your tax bracket is not going to be increased.
Yeah.
Those are not the people that they're targeting for tax increases. Right. Now, if you're in the 12% tax bracket, but when your RMDs kick in from your IRA in a few years, then you
Then look at it.
maybe you're at 22% then. Well, yeah, you should be converting it at 12. Welcome to the Wiser Retirement Podcast, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is my co-host, Shauna Theriault.
Morning.
Hey, Shauna.
How are you?
Doing good. You?
Great.
Shauna has been on quite a few episodes with us. You know her as the hardest working, smartest financial planner in the world.
Thank you.
I haven't settled completely on your nickname yet. I have a few in my head, but we'll have to announce those later. Maybe that'll be a New Year thing.
Oh, good. Do I get to approve it first?
Absolutely not.
No.
That's not how nicknames work. The problem with nicknames is that a lot of times, people have a quirk or they do something silly, and that's how you get your nickname. And that's not what we want to do here at all.
Right. No, we don't want to do something silly. No,
Right.
It's a serious.
we want to, so all those attributes are very true, and you're doing a great job here. I feel like you've been here for years and decades.
Thank you.
But we're still inside the 1 year mark.
We are.
So
actually, we're still inside the 6 month mark.
Right.
Isn't that funny?
It is funny.
It doesn't feel like
It is
that
funny.
for sure.
We definitely have the world's best team. There's no doubt about that. I'm so grateful for you guys being here, carrying out the Wiser mission.
Well, we feel that, and so we appreciate that very much.
All right. Well, we can hug later. All right. So it's November 18th is the post date for this podcast. It's episode 254, which is crazy. We started this thing a long time ago, and man, what a fun ride it's been. We've interviewed some great people. You can also see this on A Wiser Retirement on YouTube. Just go to youtube.com and you can type in A Wiser Retirement and you can see us. We have these beautiful camera angles that Rachel has put together, and we have Hadley staring at us at a distance, directing us, making sure we're staying on track, and I'm not. So we will, and we have bonus features too. So you can see other videos that we've done on various topics. Shauna, you just did one on tax.
I did a video on tax.
That's blowing up the universe
There's
right now on YouTube.
Yes, there's a lot of views just calculating tax and retirement. So that's a huge question we get, though.
That's true.
How do I know I'm not paying in my paycheck anymore?
And what most financial advisors say is consult your tax advisor,
right? Which
always made me angry.
Well, they don't have time to talk to you. They're so busy.
Well, yeah. Oh, the tax people, advisors. Yes.
Yes.
Yeah.
They don't have time to talk.
CPAs in the tax prep sense. I feel like a lot of firms they want to do the return and they kind of move on. There's not enough planning going on.
Yeah. I don't think they have the staffing for it. I don't think it's their fault. There's, if you want to find a job, any new graduates, be a CPA, because they're definitely in demand in the industry.
No, very, very true. And so what we've done here is just downloaded the right tax software to go figure out how to do this,
right?
Which we've been doing it for years, but just making it more of a regular review of our clients when they come in, that we do tax planning while they're here.
Right.
That's really important. Someone's got to be doing it. And I think that's the role of a financial advisor anyway, is play a bit of a quarterback with other professionals.
Completely. And not step on toes, but help and give feedback and have them validate it. Yeah. But, I started doing tax projections, almost 20 years ago, just to help clients that's one of the reasons I got the CPA. Like, I know you and I talked about that, just so I would understand the tax ramifications of all of it, because it's such a huge piece of a client's financial portfolio.
Absolutely. So a lot of people complain about their tax bill after the fact, after the year's end, because it's now February, March, April. The reality is you can't do much about it then. You need to, legally anyway. So you need to be focused on tax planning now before December 31st. So the planning starts before, typically September, October is when we would start doing it. We're doing this podcast mid-November. People are thinking more about Thanksgiving right now than they are about probably tax planning.
Right.
But this is your last ditch effort to take a look at what's going to be happening for the year, and you can make some changes potentially by year end. So I would say that number one is probably Roth conversions. I think that's something that a lot of people overlook or don't understand.
Right.
AARP and Susie Orman and all these other people, you got to remember, are writing articles to the masses, so it doesn't necessarily apply to you. So yes, you might be in a low tax bracket, but is it temporary? So if you're in the 12% tax bracket and you're going to be in the 12% tax bracket for the rest of your life, why would you do a Roth conversion now?
Right.
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 I mean, I can give you a couple of reasons why, but if the sole purpose is to pay the least amount of tax in your lifetime, you're just prepaying tax for down the road. Your tax bracket is not going to be increased.
Yeah.
Those are not the people that they're targeting for tax increases. Right. Now, if you're in the 12% tax bracket, but when your RMDs kick in from your IRA in a few years, then maybe you're at 22% then. Well, yeah, you should be converting it at 12.
Yeah.
Might consider converting to 22 but I probably wouldn't do that till next year until we understand what's going to happen with taxes.
Right after 25.
Unfortunately, we have the disadvantage that we're recording this before election day, so I can't tell you exactly what's going to happen politically because we don't know.
Right.
I see some really desperate reaching by one side right now, and some of the news headlines. So I have a feeling it's going to go tax favorable politicians, but if it doesn't, then we have 12 months to go figure that out. On how that's going to affect people.
Well, and we've started looking at Roth conversions for clients now, but it's the whole point. It's really important. It feels like when we're looking at tax reviews, for our flat fee planning, I see a lot of penalties out there too. So there should be if you're planning and looking at it beforehand, there should be no surprises in April. Really,
Correct.
There shouldn't be.
Right.
So whether you go to your CPA, your advisor, if they do that for you, and there's even, if you have a simple return, there's calculators online that can help you with that.
Yes.
So hopefully there's no surprises because that's just,
because you've done proper tax planning.
Exactly.
Yeah.
Absolutely.
Yeah. And I think from as an advisor standpoint, what we're looking for is opportunities to be contributing to Roths directly, backdoor Roths if you make too much money, Roth conversions to save on future tax, right? That's primarily what we're focused on.
Right.
If you're a business owner, we're not sitting here doing your tax return for you.
No.
To understand how things are going to play out. That's where you do need your CPA to be engaged with you.
Yeah.
Because there's going to be we're not experts on R&D credits and how all these other things work.
Right. And there's other things in there like potentially depreciation. There's so many other factors that are saved in the program, if you will, that calculates and does the output. And then even looking at retirement contributions for self-employed, it's really looking at up to 25% of the income, depending on what type of plan it is.
Yep.
Doing the deferrals as an employee is always good, but those other things need to be looked at with your accountant for sure.
That's a good point actually. If you're a business owner and you work by yourself, so you're an independent contractor, sole proprietor, or you run an LLC, but you're the only employee, or your only employee or partner is your spouse,
right? You
can do a solo 401k, and potentially you could put away $72,000 ish in that ballpark. 69,000 if you're under 50. If you're over 50, then you get a catch up, right?
Right. Exactly.
But you have to have things set up to do that. You can't just write a check for that. It's there's the base you can put in, and then there's profit sharing, which is technically how that's done. So it's a percentage of your income.
So you have the employee contribution, the deferral,
correct,
and then the employer.
Even though it's all the same because you're just a solo person.
Yeah.
But so those are things that you need to be thinking about now. But at the same time, those are also things like the profit sharing. That's one of the few things you can do in the new year.
Right.
For the prior year. So you could have new revenue in 2025 and say, hey, I'm just going to do profit sharing for last year to lower my last year's tax liability. And you can move that expense to the year prior. That's one of the few things you can do after December 31st. And the deadline's still pretty early because you got to file your tax return by March 15th anyway.
Right.
So you need to be doing profit sharing well before that.
Right.
So anyway, let's talk about some other things that you should be thinking about as we approach the year end. I think the simplest one is, have you maxed out your 401k, IRA contributions.
Right. And also in looking at your 401k, I really feel like, I know we have this question a lot. Should we do pre-tax or should we do Roth in your 401k? And most plans offer that now. I mean, I think that's pretty standard. And I would look at where your tax bracket's going to be, really, because we have this moment of time where in 25, we don't know what's happening yet, as you mentioned, but after 25, the tax brackets are going to adjust again. And so, there's that tax bracket in the window where, if you're married filing jointly, at 383,000 is a 22% tax bracket. That tax bracket's going to jump next year. And so, maybe if you're in the 22 tax bracket as a family, not individually, maybe you look at doing a Roth. And so you may want to change those elections now for next year, and consider doing a Roth. There's other things to consider like credits, et cetera. But generally, even the child tax credit, if you're below that 400 threshold, the 383 threshold, and that 22% tax bracket, especially since even before deductions, because it's a little bit higher if you have deductions, the standard even it's deduction. Maybe even consider doing a Roth and switching that over, just depending on, sometimes that's hard because you don't know what your income's going to be, but just be forward thinking too, to what is it going to look like next year for my income? And again, sometimes you can't plan for that. I've seen so many clients recently have RSUs, restricted stock units, where they're getting, it's a type of deferred compensation where they get their salary and then they have RSUs that are put into an account that usually vest over certain days. And there's nothing you can do about those. They just vest automatically at ordinary income. It's part of your compensation. So you have to take all of that into consideration, but, just trying to pre-plan, for this year, maxing out, but then consider, where should I be contributing next year? So you can position yourself. You can always change it mid-year as well. But just think about forward thinking to next year. Where should I be contributing to? I think that's really important.
Yeah, absolutely. Other thing would be tax loss harvesting. It's something that DIYers, so people who are just managing investments themselves, very rarely pay attention to. They're focused on usually just performance and how well a stock is done. They don't tell you about or don't want to address the losses in the portfolio. And you could have losses in the portfolio that should be tax loss harvested, meaning you can write off $3,000 a year on your Schedule D, and that comes off your income.
Yes,
that's not a percentage,
right?
It comes right off your income. So it's been a good couple of years in the market. People have less gains now, less losses,
right?
Which you think is a good thing, but when you look at your return, it's your total return, which means that what is the total cost of investing, and that's one way to get some of that cost back is by having the capital gain write-off.
Right.
And if you have capital loss carry forwards, meaning if you have something you go, this stock's never going to rebound, I'm just going to walk away from it. You sell it. Let's say you got a $10,000 loss. You can write off 3, but the remaining 7 can carry forward to the next year.
Right.
And if you sold something the next year for a $7,000 gain, then you wouldn't have to pay any tax.
Right.
So and also, it can be used in other ways as well. You could have a position that's done really well, and you need to pair that position, but you're going to have capital gains tax. That this bracket's 15, 20.
15 and 20.
And then if you're above 400,000, you're going to pay the 20% plus the Obama healthcare tax,
Medicare surtax, right? Exactly.
On top of that, which is 3.8%,
right,
if I remember
Medicare
correctly. Mm-hmm. So 23.8% is the highest you could pay in total capital gains tax. But you can also use it as an opportunity to change some things out. So you think about mutual funds. If you still have mutual funds, like who has mutual funds anymore, right?
Right.
So look at removing those mutual funds if they're in brokerage accounts.
Yeah.
Because they're going to send you a capital gains tax bill. So if there's opportunities to shift those into more ETF focus, which have a unique creation redemption process that protects you from taxes, now is the time to be looking at that. Also, too, if you're going to think about the long term in brokerage accounts, if you've got more than I'd say more than $500,000 total in a brokerage account, you probably should be looking at direct indexing. So direct indexing creates these tax credits for you as you go forward. You'll get the same rate of return as the ETF, but it's just more a tax efficient way to do things. And I think that's the value of us as advisors is understanding the complete picture.
Right.
Where most 90% of our financial advisors would say, hey, look at all this money I made you.
Right.
Well, it doesn't matter if you're going to hand it right back over to Uncle Sam.
Yeah.
So you have to do things tax efficiently. One thing I never think about this, but for people who work at really big corporations, they have the flexible spending accounts, and you have to spend that money by when?
Oh, you have to spend that by the end of March the following year, but the costs have to be incurred, I believe, by December 31st. I believe, but you can, I believe that's true.
Okay.
But I know you have to do by March 31st. They've extended it the last few years where you have 3 months into the new year to use it, which is different than an HSA.
Correct.
Usually FSA,
you lose the money if you
exactly.
don't use it.
Every year, whereas an HSA is for high deductible healthcare plan, and you can put money in there, and that's another tax deferral you can get for someone who's a W-2 employee.
Yep.
There's not many, deferral to 401k if you're doing pre-tax, and then HSA, you can max that out. But a lot of our higher net or higher income clients will defer to that and just hold it and use it for future medical expenses and use it as an investment account, a tax deferral or tax-free growth vehicle. So that's a great play.
Yeah. And typically FSAs, you set your number at the beginning of the year. So the open enrollment should be going on for most companies right now. So setting up your HSA contributions, your FSA contributions are things you want to be thinking about. But yeah, go buy those contacts, go buy those glasses, go get your teeth cleaned, do all the things that to use up those funds so you don't lose them. The max for the HSA is $8,300 for the family. It's $4,150 for an individual. HSAs typically they allow you to increase your contribution throughout the year, so you're not as locked in on those.
Yeah.
I would say look at your HSAs and how much are you building in the account. I think if you're over your deductible, you probably should have that money invested. So Optum is a big one. Fidelity, even Schwab, I think, has HSA accounts.
They do.
So you have the ability to keep those invested. I'd probably just do like a 60-40 allocation, something along those lines, and get those to work. So now's a good time to be reviewing that.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
Have you maxed out your 401k? That's another angle. You've got probably 2 more paychecks now when this podcast posts.
Yes.
So if you're going to be short, then you need to figure out how to get that maxed out. That especially if you're in the higher tax bracket, you want that to be pre-tax most likely.
Right.
You need to obviously have a plan so we know exactly what you need to be doing. But for most high wage earners, you want to do that pre-tax. I would also, something that we had a listener reach out to me via email the last couple of days. You think about matching that. Our company has a true up feature. So if you max out your 401k by, let's say, July, you still get your match based on your salary through the rest of the year.
Yeah.
Right?
Yeah.
Well, most plans don't have that. So if you're going to max out too early, then what that means is you're not going to get your full match from the company. Mm-hmm. So you do need to pace yourself. If you don't have a true up option in your 401k plan, you need to pace yourself. For all the people that I'm going to get emails from after making that comment, Delta, American, United, Southwest, all of the major airlines have true up built into their platforms. Your unions have negotiated all that.
Yes.
But for people in the normal corporate world, that's not normal to have a true up feature.
Right.
Unless you're working for a larger, if you're at a Fortune 500 company, you have a true up feature.
Probably.
Because their executives want the same true up feature.
Right.
But if you're working at a mid to small business, there's a chance that you don't have that true up feature, and you just need to make sure that you're not maxing out before the end of the year.
Yeah. Usually you can go to your plan summary description or summary plan description to see what it says and look at the details to see if you have that true up feature or not.
Correct. We talked about Roth conversions. You made a note here, Shauna, anything below 22 to 24% tax bracket, you probably would be converting. Only caveat is if you're never going to be above
right
where you're converting.
Right. Or just to fill up that tax bracket, which would take a tax projection to look at, is to say, where am I going to fill up that tax bracket?
Correct.
Because you can't just, wing it. You don't want to push yourself over.
So charitable contributions. Walk me down my options for charitable contributions. This always seems confusing to me because I feel like if I gave $1, I get to deduct $1, but that's not how that works.
I mean, sort of. It's not a credit; it's a deduction. But it
depends on what tax bracket you're in.
Right. Exactly.
So if I gave $1, I'm in the 12% tax bracket. I'd be get like 12 cents of that dollar would get.
Yeah. Yes.
Off of my return,
yes. I mean, there is like a front of the line deduction for charity, but generally, you're looking at itemization, and sometimes when you make charitable contributions, you don't even get a deduction because you're using the standard deduction. So, and that's okay. I mean, it's just because you want to still give,
Yeah. Right.
But for just generally, looking at what your taxes are projected to be, if you want to be in a certain realm, there's tons of clients that would rather give to charity than pay tax, because they're charitably inclined anyway. So, you want to be looking at it now for sure, especially depending on how you're going to be gifting it. If you're giving cash, that's pretty quick to just give cash. But if another play when you're talking about individuals that have those large brokerage accounts, instead of taking capital gains, you can gift appreciated securities, which would be transferring the security directly from your brokerage account to the charity. So that is very powerful as well, because you don't want to sell it first and then gift it. You actually gift it directly, and you don't have to pay the tax on that. And neither does the charity, because they're a charity. They don't pay taxes. So you still get the tax deduction for that, and you avoid the capital gain. If you're looking at your taxes at year end and you're thinking, okay, I just want to give to charity, but I don't know where I want to give it to, you can always do a donor advised fund as well. Many brokerage firms have it. Charles Schwab has it. Schwab Advisor Fund. So it's, a fund that you can set up to where you control it, you invest it, but you can move the securities or cash there now, get the tax deduction now, and then decide where it gets donated later. And it's also gets invested as well. So that's, one way to quickly move things to, simply move it to get the tax deduction, then decide what charity it goes to later. Right. So I like that play as well. So I know we're going to get to required minimum distributions, and you mentioned it briefly, but you can also, if you are RMD age, required minimum distribution age, you can give up to 100,000 of your distribution directly to charity. So that's another thing to look at too before year end. We do have a deadline of 12/31 for the RMDs, but that's another way to give to charities directly. You don't get the deduction for that, but you do get to avoid the income on your tax return, which is very powerful. So that's another way to give to charity and just avoid income. You still don't get a deduction, but you don't have the income on there as well.
So speaking of RMDs, a little confusing now. It used to be at 70.5, you take so much of your money, but
I literally have to look at the chart every time. Like, wait, what is your date of birth?
Right. So it doesn't, 70.5 is not a thing anymore. So you're either going to take it at 73 or you're going to take it at 75.
Right.
That's Secure Act 2.0.
Unless you're already taking it and you're before 73, then you still have to keep taking it.
Yes,
so
that's
then,
correct.
Right? You see, that's where it's still confusing.
Yes. So if you're a wiser client, we have a list, and we make sure you get your RMD out before year end. So you don't have to worry about that. If you're not a wiser client, then yes, you need to make sure that your advisor, or if you're self-managing, that put your birth date in. You can do these calculators online. You can go on what is my RMD age, and you'll just type in your birthday and it'll tell you.
Exactly. It has a calculator for you. And if we have any new listeners, it's required minimum distributions that you're forced to take from your retirement accounts at a certain age and pay tax on them.
Correct.
So this is that pre-tax deferral we've been talking about into the 401ks, you know, the traditional, if you will, where you get the tax deduction now and you pay taxes later. They force you to take it out at a certain age. Roths and Roth 401ks, as of today, the way the tax code's written, and I say that because things change all the time, you don't have to take a required minimum distribution. So we're speaking about IRAs and sometimes 401ks, depending on the situation there. Generally speaking, if you're still working and you're less than a 5% shareholder or owner of the company, you don't have to take RMDs. So I've had many clients work beyond well into their 70s because they wanted to, not because they had to, and they got to avoid that for now. But generally speaking, we're talking about IRAs.
So if you inherited an account, there will be RMDs as well. And that's been very confusing over the last few years. I think Congress in the Secure Act, they intended to change the rules to be 10 years after you inherit an IRA or a retirement account. Within 10 years, you'd have to take a full distribution. Or before, you could carry out that tax deferral for a very long time.
Yes.
Now, the question is, do you have to take an RMD over those 10 years? And the IRS says yes. Congress said no, but the Congress did not come back and say no officially. So the IRS got the rule. And now, yes, you do need to take an RMD based on the 10-year rule, except it's been so confusing that the IRS has given an exception.
Yeah.
And they've said, hey, if you didn't take one, then you don't have to pay the penalty.
Right.
There's no penalty for not taking one.
Right.
so that penalty, that freedom still applies to 2024. So you don't have to take an RMD in 2024 on an inherited IRA, or if you didn't take the RMD, there's no penalty. Is probably the better way to say that.
For a newer one, yeah.
For a newer one,
yeah.
Yes, if your loved one passed away years ago, you're still taking your RMDs.
Right.
So now, if you roll into 2025, that exception probably would not be true.
Right.
So,
and they did clarify earlier this year. I still think it's clear as mud, but they clarified that if the decedent, the person who passed away, had already been taking required minimum distributions, then you have to continue the RMDs annually. And if they were young, then you can take it anytime in the 10 years. That's the ruling that I saw, but yeah. It could be different. So
it's very confusing, and CPAs are still struggling with it as
sure,
well.
The
safe thing to do would be to take RMD, but I know that if you don't, if you didn't in the years prior, that you're not going to pay a penalty for that, because the penalty for not taking your RMD is pretty steep. It's
50%, I believe. At least that's what it used to be. 50% of what
you should have taken out.
Exactly. So it's like still take it out and penalty on top of that.
Right.
And when you take it out, if you're taking it from that account because that's your only asset to take it from, then you pay tax on that distribution too.
Yeah.
So you pay tax on your tax.
Right.
That's always been. But this is a good point with the inherited IRAs, because that's something we look at annually, and this is a non-spouse we're talking about. If your spouse inherits your IRA, then they can treat it as their own. Right. So this is really, we're talking about kids, brothers, whatever, girlfriend, whatever, whoever inherits a retirement account that's not your spouse. And so when looking at that, this is part of tax planning, because you have that 10-year period where you have to take it out. So you have the minimum potentially that you have to take, right. But should I take more? Well, it depends. Do you have some RSUs coming due next year, and your taxes are going to be lower this year, the next, then maybe you bunch it all in this year. Plus, depending on what tax bracket you're in and what they do with tax rates could be going up after 2025. So maybe you bunch it a couple times, so we don't have a lot of clarity right now. We will have clarity soon, but just taking that into consideration, looking at potentially taking more, because you have to distribute it within 10 years, depending on, and sometimes we don't know what our income's going to be. I mean, we don't know if something's going to happen, unplanned, of course, but we have to make the decision, based on what we know now. And right. So just, doing it equally over 10 years potentially, but also bunching up and doing more in certain years where you think your income may be lower.
Right.
So, I mean, I think that's important to look at that on an annual basis as well around this time.
In addition to that, you might want to consider looking at the annual gift tax exclusion. So if you wanted to give money away to a loved one, you can do so without having to pay any type of gift tax, as long as you keep it below $18,000
per person. Yes.
Per person. So that means if husband and wife wanted to give to their daughter who's married, the wife could give $18,000 to the daughter. The husband could give $18,000 to the daughter, and then the husband could give $18,000 to her spouse, and the wife can give $18,000 to her spouse. So you can move quite a bit of money.
You can, and you can give to their children too.
Correct. You can give to their children. So make sure if you're trying to remove assets from your estate, that's the simplest way to do it. There's no form to fill out. You just have to keep it below those minimums. Now, if you have a sizable estate in the next year, I'd probably wait till 25. You want to take a look at your lifetime exclusion.
Right.
And that requires an IRS form to be filed with that. But right now, that for a married couple, it's over $22 million.
Yeah. It's really high.
It's really high. But that number could be cut in half depending on what happens in Congress over the next 18 months or so.
Yeah.
So we're all watching that very closely. I'm sure there'll be other podcasts about it when it comes time.
Another thing to think about too is just prepaying or paying deductible expenses. You know, with the standard deduction being as high as it is, a lot of Americans don't even itemize anymore. You know, it used to be you'd save up all your receipts and, you know, have all of everything that you could deduct, and they took away so many of that, but you still can deduct some. You know, the state and local taxes, there's a limit of 10,000, but that's, you know, what did you pay to your state or local municipality? So you have those taxes. Any medical expenses, they still have the AGI thresholds, but medical expenses. So again, making sure you're paying those in this year, to the extent you can. Not any that you're using through FSA or HSA, because that's double dipping, but, you know, getting those together. And really, you know, property taxes is another one. Usually property taxes is due around this time anyway. You know, there used to be that play where you could pay it next year, this year, et cetera. And kind of, you know, if you don't, depending on when the taxes are due, you could push it to the next year potentially, but going ahead and paying it in this year so you get the deduction. And then mortgage interest, typically that's just throughout the year. So there used to be other things that we could deduct. Charitable is another one, looking at the charity deduction. So, you know, just going ahead and looking to see where are your deductions this year comparatively to the standard, and then making sure that you pay into them so that way you can get the deduction and keep records of that.
You can also, for business owners, look at paying your state taxes through your S Corp. That's something that your CPA can help walk you through. But, you know, you can pay the corporate tax at the corporate level, or you can pay it at the personal level. So most people everything passes through the personal return and they file it there. If you file it as a business expense at the S Corp level, right, then you get that deduction off your business tax return. So that's something to consider. And then also, I mean, if you have any expenses that are going to carry into 2025, maybe go ahead and write checks and expense those this year, as opposed to waiting for 25. It all depends what you're trying to do. Business owners, we have to be careful, because if you write off too much and you have less net gains than you did the year prior, and you try to get a business loan, they're gonna be like, well, what's wrong with your business? You're losing money. It's like, no, I was just being tax smart.
Right.
A banker doesn't understand tax smart. I mean, quite honestly, bankers don't understand much of anything. I talk to bankers and I'm like, how do you not know anything about business? So you need to make it easy for them, where you're showing them a gain every single time, year over year, ideally. So don't expense too much to where you have losses. Also, if you're trying to sell your business, buyers don't understand why you don't, you know, all they know about your business is the P&Ls that you show them. So those are the years it's probably better just to pay a higher tax and not try to hide your family vacation somewhere inside your P&L. You need to have show as much profit as possible. So it depends on what you're doing. If you're trying to get loans, maybe it's better not to be as tax smart for that year. But if everything's going great, you might consider 2025 expenses in 24. Of course, that means in 25 you're going to be paying more tax, but $1, right? 2 birds in the hand, whatever that saying means.
Right. So then I guess you look at the end of 25 and start pushing 26 expenses 25. It's like you're always
if you can do that, if you can afford bonuses, maybe it's better to do those in the year, the same year versus doing traditional like February, March bonuses for the year prior. If you're prepared to do that, some people don't have their P&Ls ready enough in time for that. But anyway, there's a lot of different things you can do as business owners that have legit businesses, not the businesses that are hobbies that you're trying to lose money on on purpose. I never understood that. I get that question often. But anyway, I think that's kind of the top of our list. The big thing is you sit down, you understand what's happening in the overall financial picture. And that's what's great about financial planning is for our clients, we have that picture always. As long as you're coming in for review meetings, we have that picture. And so it's much, much easier for us to give advice when we can see what the long-term plan is and what we need to be doing short-term with money. Because again, it's really hard to read magazines, even listen to a podcast and think, how do I apply that to myself personally?
Right.
But anyway, thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management and want to work with one of our fiduciary fee-only advisors, you can do so by clicking on our show notes. You can go to wiserinvestor.com. Sean, I'll be happy to work with you. Missy will be happy to work with you. They're trying to get me out of giving financial advice and just be a CEO. It's really hard. I like working with you guys. But we have a couple other episodes you might look at. We have episode from last year, 196, your year-end financial planning checklist. Episode 190, year-end tax moves, planning ahead for stress-free tax season. And then don't forget about our YouTube channel. Reduce your taxes in AGI by giving to charity. And then what is the best way to take your RMD? Those are all YouTube videos that we did a little while back. Also, if you have a minute, wherever you're listening to this podcast, go and like it and subscribe and tell other people about it. We have so many new listeners and we're really excited about this. So keep helping us grow the brand of fiduciary fee-only wealth management. Thanks, guys. We'll see you next week.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced by Rachel Dotson. This podcast is strictly for informational purposes only and is not to be considered as investment advice or solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investor advisor with the SEC. The host and/or guests may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guests of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.